Hey everybody, hope everybody's doing well. Just going to give it about 10 or 15 seconds, let everybody load in, and then we'll get things kicked off. All righty, well, I'll go ahead and start things off here. I just want to welcome everyone and thank everyone for joining us today, joining CFA Colorado and CFA Orange County for this co-hosted webinar, Moneyball Investing, Avoiding the Losers in a Portfolio, sponsored by New Age Alpha. We want to welcome today in our speakers, Julian Koski, the co-founder and CIO of New Age Alpha. And we also have Andy Kern, Senior Portfolio Manager and leads the research efforts at New Age Alpha. And last but not least, Mark Burns, the Project Manager at New Age Alpha. And with that, thank you guys, and I will pass it along to you guys.
Thanks very much. I'm going to share my screen. Give me a moment to figure some of these things out. There we go. Should be good. Close that down. If you don't mind, we're going to stop the video just because it's easier from, we've got some tools to show you and it just uses up some bandwidth. So with that, thank you so much for listening to us today. We're going to spend the next hour working between myself and Andy Kern and Mark Burns. What we're going to do is I'm going to start off by actually asking everybody a question. And the question is, did you know that in July 2019, Tesla was trading on a split adjusted basis around $50 a share? Today, it's over $1,000. And the question I have is, how did so many Wall Street investors get Tesla so wrong? And they did get it wrong. The answer to this may lie somewhere in baseball. I'm going to ask you to try and forget about what you think you know about portfolio management and stock selection. Please don't try to fit our process and model into what you may already know. Please keep an open mind, and I promise it will all come together for you at the end. New Age Alpha is active investing reimagined. Using actuarial science, technology, and data, we take existing investment universes and make them better by avoiding the losers. We are a dramatically differentiated source of alpha and an uncorrelated source of return. And we provide investors with exchange-traded funds, indexes, SMAs, and tools. Today, I'm going to present three things. First, I'm going to tell you the New Age Alpha story. Second, I'm going to demonstrate the H-Factor system. The H-Factor system is a premium tool that we provide free to all advisors. Mark Burns will then show you our exchange-traded funds. Let's get started. So why re-engineer active investing? Well, we believe active investors have relied heavily on an information advantage, and that information advantage is now gone. Since 2001 and the passing of Regulation Fair Disclosure, the information advantage has been arbitraged away, yet active investing has not adapted. With that now gone, we believe active investing is now simply relying on a lot of speculation. We recognize this need for change and have built a solution that combines, as I said, actuarial science with technology and data. It's rules-based, and it's repeatable and uncorrelated with traditional active managers without the risk associated with traditional active stock picking. However, the process all starts with how we think and measure risk. So we're often asked what risk exactly New Age Alpha is identifying. The answer to this can be thought of by breaking down total risk into two parts. The first part is the type of risk most investors focus on, and usually how total risk is measured. This is called the price risk, the risk that we hear about in standard asset pricing models, like the capital asset pricing model. This includes things such as market sensitivity or beta, but also things like size risk, style risk, momentum, all the factors one can observe. These are price risks because when an investor observes them, he or she will discount the price they're willing to pay. For example, we know what the beta is, and holding all else equal, we will be willing to pay less for a stock with a low beta. The second part of risk is the more interesting one: idiosyncratic risk, sometimes called unsystematic risk or firm-specific risk. It's a risk that is specific to a company, like a catastrophe at the plant, or a lawsuit, or the sudden death of a CEO. This type of risk is usually ignored because it is assumed it can be diversified away. Now, we agree this is the case for firm-specific risk. But what about stock-specific risk? What about the risk that stems not from things happening to the company, but things happening to the stock? We are talking about an idiosyncratic risk created by human behavior that impacts stock prices specifically. It leads to loss, and unlike firm-specific risk, it cannot be diversified away. It can only be avoided. This risk arises from human behavior making a stock risky, regardless of how risky the company is. It is the risk of overpricing. We believe it's the mother of all risks, and failure to understand this risk is an epidemic problem within the asset management business, which leads investors to mismanage their portfolios and lose money. A little bit about ourselves. I founded the company together with Armin Aris, New Age Alpha, in 2018. Armin and I have been working together for the past 22 years. Prior to this, we built and sold Transparent Value, a company we built to Guggenheim Partners. At that time, we were managing a platform of mutual funds, and we were sub-advising insurance companies on fixed and variable annuities. Our core team has been together for more than 12 years. Andy Kern joined us a number of years ago, and Andy's joining us on the call today. So we've had a long history of working together. Not only is that important in terms of our business, but it's also important in understanding how to research and develop these types of methodologies.
Thank you, Julian. So I'd like to relate this to the title of the presentation by explaining how the people who run baseball clubs are a lot like the people who run investment portfolios. So the problem is they always think in terms of buying the big names in order to put together a winning team. And as you know, often this is a failed strategy, and the teams with the most money and the biggest payroll do not win the World Series or other championships. And I think that's because their goal shouldn't be to buy high-profile winners. It should be to avoid high-cost losers. So I'm sure most of us are familiar with the concept of Moneyball and have probably read the book, which was published in 2003, or seen the movie, which came out in 2011. But to recap, the story goes something like this. So the Oakland A's were a struggling ball club. They had a tiny payroll, and they were trying to put together a team that could win. But their scouts were using these traditional and outdated and really ineffective methods for identifying talent. Things like judging a player's confidence or judging how good looking the player's swing was. And of course, this was not helpful, but it was really all the scouts knew how to do. Now, meanwhile, we had Billy Beane, who was the club's general manager, and he had a different idea. Instead of focusing on predicting the future of a player or buying superstars, he would focus on the statistics only. And a lot of the statistics were not new, things like on-base percentage. But in the past, they had not been given the attention that they deserve. So Billy Beane set out to find undervalued players by judging them not on their intangible qualities like the look of their swing or their confidence, but strictly on things like on-base percentage. Well, this frustrated, in some cases, it infuriated the scouts. And Billy Beane had made a risky decision. He was violating the orthodoxy, and he was offending many people in the game. But the result was with the outcomes of the games, the randomness of them was reduced. And in the end, The A's won 103 games in 2002. They had a record 20-game winning streak in August, and Billy Beane was vindicated. But today, statistics are really widely used to evaluate players throughout not just baseball, but all sports. So with this story in mind, think about an investment portfolio. We believe that the investing community is really medieval in its thinking. And even today, long after the lessons of Moneyball, 20 years gone now, many people are continuing to ask the wrong questions of a stock. It's not about beta or volatility. It's about getting things down to a single measure, a measure that answers one question only. This is the key. What is the probability that the company will fail to deliver the growth implied by its stock price? So the Oakland A's exploited the on-base percentage metric. At New Age Alpha, we exploit the human factor metric. So just as Billy Beane rejected the conventional wisdom in baseball, we believe it's time to reject the conventional wisdom of investing and start asking the right questions of the companies that you want to own. And as an investor, you should think of yourself as the Oakland A's, trying to build a winning portfolio the same way Billy Beane put together a winning club.
I'm going to say something that might be shocking to some of you. Most investing outcomes are a result of luck, not skill. Now, how do we know this? We know this because in order to be skilled at something, you would have to be able to be deliberately lose, and you cannot. Roger Federer can deliberately lose, which is good evidence that Roger Federer is a skilled tennis player. He can control the outcome of the game, essentially. However, when it comes to investing, you can go long a stock, but it might go down, and you can be short a stock and it might go up. You see, you can't control the outcome. Investing outcomes, believe it or not, are purely random outcomes. And if your portfolio is subject to random outcomes, the best approach is the use of mathematical probabilities. As an investor in a mutual fund, what would you say your odds of generating positive alpha are over a 5-year period? Take a look at these two charts. On the left, we have shown the alpha of all the US large cap funds generated over the 5 years ending 2016, ordered by alpha. The odds weren't good. Most funds produced negative alpha in that period. Now on the right, we keep the funds in the same order, but show the alpha of the funds over the subsequent 5-year period. What you're seeing is random noise. Knowing the returns in the first period would have told the investor absolutely nothing about what would have happened in the second 5-year period. So as you can see, and as I've mentioned before, investing outcomes are purely random. So where does this problem all start? Well, it starts with investors' imperfect understanding of where alpha actually comes from. It's not about trying to pick winners. It's about trying to avoid the losers. Let me clarify for you. I was to draw a straight line, and that straight line was the S&P 500. And I asked an audience of portfolio managers, how would you design a portfolio to beat this S&P 500? Most, if not all, are going to say, they probably will say trying to avoid the losers, but we all know in our hearts that it's all about picking the winners. But to pick a winner, you have to have knowledge of the future. And the future, as we all know, is unknown. The more we forecast this unknown future, the more we're just increasing the likelihood we're going to be wrong and invest in the loser. Forecasting the loser is a nice way of saying it's really more about gambling. So in the absence of a proprietary information advantage, how do you actually build such a portfolio? Well, at New Age Alpha, we've designed this whole process around avoiding losers. And we've divorced ourselves completely from traditional portfolio management ideas. And instead, we've drawn on the principles of insurance. You see, if you look at the insurance industry or the gaming industry, it's all about avoiding losers.
So what is a loser then? How do you know when you're going to lose money? Well, I think in simple terms, it's just a stock that's overpriced, but that overpricing is caused by human behavior. So overpricing is not caused by the fundamentals of the company. It's caused by humans. So how do humans overprice a stock? Well, we all know the efficient market hypothesis says that a company's stock price reflects all available information, but this includes both knowable information, known information like the disclosed financials, but it also includes information that's vague or ambiguous in nature. And this is a very important distinction. Vague and ambiguous information may and probably is relevant to the price of the stock. The problem is investors may not agree on how to interpret it. So on the other hand, you have the known information, as we call it, and it is easy to interpret. And because it's easy to interpret, it's usually interpreted in a consistent way among investors. Therefore, it's impounded into prices mostly accurately. So our contention is that humans interpret vague or ambiguous information in a systematically incorrect way. So just think about the scout who thought that, how a player's swing looked meant that he could compete at the big league level. This happens in the stock market all the time. When Steve Jobs passed away, half the investing population interpreted this as a good thing, pushing Apple's stock price higher. The other half saw it as a bad thing, pushing Apple's stock price lower. The point is, it was vague information. And this is very similar to the way the Oakland A's scouts were judging characteristics of players that had nothing to do with how much the player could actually contribute. They were relying on information that was really vague or ambiguous at best. So if you don't have a proprietary information advantage, then the next best thing is to use probabilities. And these probabilities have to be calculated from known information only. So just look at Tesla or the COVID epidemic or GameStop. There's an overwhelming amount of vague information or ambiguous information in the market today. In fact, there's probably more vague and ambiguous information than there is known information. Well, this information can get impounded into stock prices and ultimately lead to the overpricing or the underpricing of a stock. So what risk does this create? Getting back to what I had said earlier, it's the risk that the company will be unable to deliver the growth implied by its stock price. Remember, the growth implied in a stock price is determined, the growth implied in a stock is determined by the price you pay for it. The higher the price you pay, the more growth the company will have to deliver. And thus, the higher the chance the company will fail to do so. This is the key point. If a company will be unable to deliver the growth implied in its stock price, it's likely to be a loser. So let me give you a simple hypothetical example where we look at two hypothetical prices for Tesla. We have Tesla at $500 a share. Well, this stock price has meaning. It means that in order to support that price, Tesla has to sell a certain amount of cars and generate a certain amount of sales. So let's just suppose these numbers are made up, of course, but let's just suppose this means that Tesla has to sell 1,000 cars. Now, how do we know if Tesla can achieve this? How do we know if they can sell 1,000 cars? Well, suppose that in the past it sold 1,000 cars every quarter. We could infer that, at least based on its past, Tesla has very little chance of failing to sell the 1,000 cars that it needs to next quarter. So this would make Tesla's investing on base percentage near 100%. Now, in contrast, suppose that Tesla trades at $2,000 a share. Okay, this will imply a much higher rate of growth. Perhaps that means it has to sell 5,000 cars per quarter. And because in the past it has never sold more than 1,000 cars per quarter, there's now a low probability that it will sell the necessary 5,000 cars. So maybe you could infer that this probability is 20%, meaning Tesla's on base percentage is 20%. So from this, we can tell that the lower the stock price or the higher the past growth rate, the easier it will be for the company to reach base. So turn it back over to Julian. What is investing on base percentage?
So the human factor, which we have developed, we believe is investing on base percentage. I'm now going to show you how this is calculated and used. But before I do this, let's go back to the question I posed at the beginning about Tesla. Why did so many Wall Street get read Tesla so wrong? Well, in short, it was the human factor, and I'm going to explain. It really was humans impounding vague and ambiguous information into Tesla's stock price, which ultimately created a risk of underpricing. You see, it works both ways. Not only does vague and ambiguous information overprice a stock, it can also underprice a stock. Just like the scouts, Wall Street was trying to forecast what Tesla might become, relying heavily on the interpretation of vague and ambiguous information, instead of focusing on Tesla's on-base percentage. We have a saying, manage risk like an actuary, not like a portfolio manager. Think about it for a moment. When you buy insurance, do insurance companies ask you, are you going to quit smoking or are you going to go to the gym? Imagine trying to underwrite risk based upon this type of vague and ambiguous information. The insurance industry relies on probabilities to determine mortality or risk. And what I'm going to show you now is an investment process that uses the principles drawn from the insurance industry. In both the Moneyball example and the insurance analogy, in both cases, it's only known information that is used to calculate the probabilities. And when it comes to stocks, there are only two things absolutely known about a stock: the company's stock price and the publicly available information, the financial statements. The first step is to calculate the growth implied by the stock price. Remember, the higher the stock price, the more growth will be implied by that stock price. To explain this further, let's take a closer look at Tesla. In July 2019, Tesla was trading at $253 a share. Now, using this price together with the financial statements at that time, we calculated the implied revenue growth Tesla needed to support that $253 price. And from the math, you see that Tesla needed to generate $6.1 billion in revenues. This further implied that Tesla had to sell around 95,000 new cars per quarter, which equates to a quarterly growth rate of 39%. Now, the second step, and probably the most important step, is to calculate the risk of failure. In other words, what was the probability at that time that Tesla would fail to deliver this growth rate? To do this, we look back over the past 12 quarters, and we look to see how many times Tesla actually delivered this revenue growth rate. And we build a distribution curve. And what you can see from that is that Tesla's average growth rate over those prior 12 quarters was 49%. They failed to generate the implied revenue growth rate of 39% only 20% of that time in the past 12 quarters. So if you think about it, Tesla was generating this growth rate almost 80% of the time in that prior period, over those prior periods. Remember, step one is to calculate what the growth rate implies. Step two is to plot that growth rate relative to a distribution of prior growth rates to see how many times they were delivering that growth rate. And they were delivering it 80% of the time. So the human factor is around 20%. It's very little. There was very little human factor in Tesla stock price. But let me give you some context for this. At this time, back in 2019, there were 169 newspaper headlines about Tesla out there. And of those headlines, 129 of those headlines were negative. You had David Einhorn and Jim Chanos shouting bankruptcy, fraud. So I repeat, Wall Street missed Tesla because they were trying to forecast what Tesla might become instead of looking at Tesla's on-base percentage. It was the immensity of the negative, vague, and ambiguous information getting priced into Tesla's stock. And that behavior was simply underpricing the stock. The human factor captures the impact of human behavior on returns, specifically as it relates to the interpretation of vague and ambiguous information. The higher the probability, the more likely vague and ambiguous information has been impounded into the stock price, and you will want to avoid it. The benefits of avoiding the human factor. And from this chart, you will see that there's evidence to our thesis that low human factor stocks outperform high human factor stocks over time. In this chart, which examines the period 2003 to present, you can see that the quartile of the S&P 500 that includes high H factor stocks in red underperforms the quartile of low H factor stocks shown in green by an annualized 3.9%. Because we form these quartiles on an equal weight basis, we also compare them to the S&P 500 equal weight index. And as you can see, high H factor trails this index while low H factor beats it. And this is essentially how we built one of our products, our hedge fund. Long, the top 20 names in the S&P 500, short, the bottom, the high H factor stocks of the S&P 500. What is more, the low H factor quintile comes with less volatility and a much higher Sharpe ratio. This is the most important thing, though, to remember. That the H factor works 65% of the time on a quarterly basis. In other words, high H factor stocks underperform low H factor stocks 35% of the time. So on a 65% of the time, low is beating high. So if you think the stock market is made up of lucky gamblers, these are great odds. I'm now going to further evidence this methodology for you and show you how you can use this process in your own business. What we're going to do now is I'm going to switch to the H factor system. What's important to note is the H factor scores are calculated every single day, right? Of course, because the stock price is changing, you're going to get a new H factor score. But much more, and more importantly, they're also changing on a quarterly basis when new financial statements are coming out. Now, the H factor system records the H factor scores for all the stocks. We have around about 8,000 stocks globally. We have the ability to look at equity universes. We have ESG universes, fixed income, exchange traded funds. We have the ability to look up the H factor score for all the ETFs out there. We have the ability also to load your own portfolio into the system, and the system will optimize your portfolio for the human factor. But today, what I'm going to show you is the equity universe. And what you can see now, we cover countries from China through Japan. And so what are these numbers saying on the side here? Well, these are the median H factors, right? So one would argue that Japan has got a lot of vague and ambiguous information pressed into its market right now. China would have what we believe would be the lowest of H factors, and the USA is around 38.5%. Let's keep going into the H factors, and let's open up and get to the S&P 500. So on the left-hand side now, I've got the ability to drill down into all the sectors, subsectors. I can go all the way down. I'm going to stop here for a moment. In the middle here is the S&P 500 organized in a circle from lowest H factor to highest H factor. So right now, I'm just going to click right here. ServiceNow has the lowest H factor in the S&P 500 of 1.9%. So let's just recap the math. So we took the stock price of $573. You work backwards to calculate what ServiceNow's implied growth rate is. And once we have that, we plot that growth rate on a distribution of prior growth rates that we determine from the prior 12 quarters of information from ServiceNow. You can see that Costco has a 2.3% chance, Walmart 2.5, BlackRock 3.0. So these are the low H factor names. These are the names that we would invest in. We would say that there's very little vague and ambiguous information here, and we believe these low H factor stocks will outperform the high H factor stocks. But now, if we keep going around the circle, let's just keep going around. So what's happening is the H factor, of course, is getting higher and higher. And on the left-hand side over here, for instance, there's Royal Caribbean. Royal Caribbean has a 65% chance, based on our math, that it will fail to deliver the growth, right? They've never delivered this growth that's implied by that $82 stock price, but yet it's being priced at $82. Remember, this is all about avoiding the losers. Let's go and have a look at Tesla, because we've been talking about Tesla so much. Let's look at Tesla's score today. Well, Tesla has a 20% chance that it will fail to deliver its implied growth rate, right? So if we think about it, Tesla's still very much, even in all the news and what it's doing, Tesla still, from our perspective, has a very high likelihood it will deliver the growth implied in the stock price. And yet, still so much news and so much information coming out about Tesla. But the math is saying something different. But let's get back to what the thesis is, that low H factor stocks outperform high H factor stocks. Well, let's put that to the test. What I'm going to do here is I'm going to remove 10% of the names in the S&P 500. I just want to be clear about what we're doing here. We've taken the S&P 500 and we've gone back to 2001. We've calculated the H-factor scores every quarter using data available at that point in time to come up with those H-factor scores. What you can see, if you remove 10% of the highest H-factor names, you would have improved your returns on an annualized basis by about 0.27%. What happens when we take out 20% of the names? Well, now it improves to 0.73% on an annualized. If you take out 30%, you're getting over 1% on an annualized basis. If we take out 50% of the names, half the names, you would get 1.98% on an annualized basis. 70% of the names gives you 2.71, and 85% of the names, 3.43% on an annualized basis. So you can see the more concentrated the portfolio gets around the lowest H-factor scores, the better the returns. In fact, I'll highlight for you this area in green. This is where our one ETF has been designed, AVDR, where we invest in the lowest H-factor scores. Now, we can take this thesis and apply it to almost any investment universe, and we get the same stunning results. Let me go back to the beginning, and let's click on the ETFs out there. We've got all the ETFs from all the different companies loaded here. Let's bring up a couple of ETFs and have a look. If we apply the same thesis to those ETFs, what actually happens to performance? I'm bringing up Wisdom Tree. This is an ETF of Wisdom Trees. It's called the Wisdom Tree US Quality Dividend Growth Fund. It has 290 components in it. And this ETF has been around since 2013. Let's test the thesis, right? Let's take out half the names in this portfolio. Removing half the names in this portfolio, you're getting 1.96% on an annualized basis, additional since 2013. Now, what I'm showing you here is the beginnings of our direct indexing platform. Not only will you be able to remove the losers, you'll be able to tax optimize this portfolio and buy it inside an SMA. This little buy button will be active very soon. So the ability to not only avoid losers, avoid taxes, avoid high fees, and the ability to avoid ESG companies that you might not want to invest in. Again, we can take this and apply it to other ETFs. I'm bringing up an ETF. It's the Goldman Sachs Hedge Industry VIP ETF. It's an interesting ETF because this ETF owns the names of some of the highest conviction names some of the biggest hedge funds have out there. Everything from ServiceNow, Amazon, Five, Shopify, Square, NVIDIA. Well, let's do the same thing. Let's remove half the names. If I took out half the names of this ETF on an annualized basis, you're getting 2.14% additional. Again, the ability to remove the names and optimize will be available very shortly. So with that, that is the presentation of the H-factor system. What I'm going to do now, let's just going to switch back to the PowerPoint and move on to the next slide. So the features of the human factor is it's a measure of mispricing. We calculate this daily from only known information. It represents a stock-specific risk. This is different than an idiosyncratic risk at the firm level that cannot be diversified away. It can only be avoided. And most importantly, low human factor stocks outperform high human factor stocks 65% of the time on a quarterly basis. With that now, I'm going to turn it back to Andy Kern, who's going to talk you through some of the diligence around the H-factor score.
Thanks. Yeah, a natural question that comes up and that we're often asked is about the correlations of the human factor with other risk factors, more traditional risk factors, because you want to answer the question, is human factor simply one of those other factors by a different name? And so the answer is no. But to show this, we can show this in two ways. The first way we can do this is by just performing a correlation analysis of human factor returns and other common factors. So let me clarify. When I say human factor return, what I mean is the ability of low human factor stocks to outperform, or the tendency of low human factor stocks to outperform high human factor stocks. So it's a low minus high portfolio. And this is to stay consistent with the calculation of other factors, such as the Fama-French factors, which are calculated in the same way. So we use those the Fama-French 5-factor model, which includes a beta or market factor, but also value, size, investment, and profitability. We also include momentum factor, which is often added to that model. And then we've also analyzed several other factors that are of interest to investors, like quality, dividend, and just volatility. So like a low vol factor. And what we found is that this strongest correlation is only 0.43 on an absolute basis. So if correlations can range from -1 to +1, 0.43 is relatively weak for being the strongest of the different one-way. These are one-way correlations. So it's each factor's return correlated with human factor return. But the real question is whether there is some combination of those factors that explains human factors return. So to do this, we run a regression. We run a 9-factor regression. And this will tell us not only how much of human factors returns is explained by those other factors, but also how much is left over and how much can we actually contribute. So we've displayed the coefficients on each of those factors, and additionally the intercept, which is your alpha of the regression, as well as the R-squared. And from this we can see that the aggregate ability of all those 9 factors to explain human factors performance is really pretty weak. It's only 39%. So the R-squared of the regression is 39%. And then, as I mentioned, the intercept, or the alpha, is 18 basis points per month, which equates to 2.22% per year. So after adjusting for all 9 factors, we're still able to produce very sizable alpha. Okay, and then, as I mentioned, we've chosen to focus on these 9 common factors, but to further support the claim that human factors capturing something different, we performed what's called an X-ray analysis. Now, the X-ray of the human factor shows the combination of factors at any point in time that best explains the returns of the human factor over the prior 2 years. So it's a rolling 2-year window. And you can see, for example, in 2015, the performance of the human factor was largely explained by the quality factor, which is shown in orange. In 2008, it was largely explained by the profitability factor, which is shown in green. And in other years, there's some combination of factors that did the best job explaining human factor. But the key takeaway is that human factors exposure is dynamic. It's constantly changing. Now, below this is the performance of a shadow fund. The shadow fund takes the proportions shown in the X-ray, and it holds a passive portfolio of those factors. So the performance of the shadow fund, which is the orange line, is basically the exposure to factors only without any benefit of stock selection. So just passively owning the different factors that explain human factors return. Whereas the blue line in the chart is the return of human factor itself over time. So the difference, therefore, the gray line, is the portion of human factors performance that's attributable to security selection and not factor exposure.
So the question we have, and important one to answer, is, are we building a Moneyball portfolio or a Scouts portfolio? And as you've seen, there's very strong distinctions. Moneyball portfolio is designed to avoid losers. The key is that it relies on the use of probabilities, not on trying to forecast the future. And at the heart of that is avoiding the use of vague and ambiguous information. Again, ask yourself the question, and the key question is the information advantage being arbitraged away? If the answer to that is yes, then the only thing we have is the use of mathematical probabilities. I'm going to hand it over to Mark Burns, who's going to talk to you about our ETFs that we've just recently launched, and then we will take some questions and answers.
Thanks, Julian, and hi, everybody. Thank you for joining us today. So at the end of 2020, we launched our first two avoider ETFs, and they are ticker symbol AVDR, which is the avoider US large cap leading ETF, and ticker symbol AVDG, which is the avoider US large cap ESG ETF. And let me describe to you how each of these ETFs create their portfolios. So AVDR, which again is the US large cap leading ETF, its universe starts with the S&P 500. And then in building the portfolio, first we run a liquidity screen. Then the human factor score is calculated for each stock, and all stocks except the 50 with the lowest human factor scores are removed. Then each stock is weighted by the inverse of the human factor score so that the stocks with the lowest human factor receive the highest weight. There's also a maximum 3% overweight per sector compared to the S&P 500 at time of rebalance, and the portfolio is rebalanced quarterly. Let me show you how we put that process into practice. So as I said, the universe for AVDR is the S&P 500, and we show each stock on the screen here by the blue bars, and they're ordered by weight, which, as you know, it's driven by market cap since the S&P 500 is a market cap weighted index. There's a couple things that you should notice. First, there's a few very large weights. These are the stocks on the left side of the graph, and these are the mega caps. These are stocks like Apple, Google, Amazon, Facebook, and Tesla. But there's also many very small positions. Now, keep in mind that these are all large cap stocks because we're looking at the S&P 500 universe, but they're dominated by a few mega caps. Now, most of these stocks are too small to make a difference. In fact, there's around 300 stocks that have weights of 10 basis points or less in the S&P 500. So these stocks can double and they still won't have much of an impact. Now, the orange bars, this is AVDR's portfolio. Now, we may own some of the largest stocks, some of the mega caps, and we do, but we typically own them in much smaller position sizes. Where we're different is by the other stocks in the portfolio, because we only keep the 50 stocks with the lowest human factor scores. While the stocks are weighted by H factor or human factor, the weights are very consistent. Typically, portfolio holdings range from 1.5% to 2.5%. This also means that there's not a lot of risk from any one stock, but each stock can also have an impact on performance. This is how we seek to drive alpha and why we believe AVDR can be a good complement to existing large cap strategies. We use a different process and provide a differentiated portfolio, which provides a different outcome. Let me spend a moment on AVDG, which again is our ESG ETF, the US large cap ESG ETF. So that universe starts with the 600 largest stocks in the Refinitiv US Total Return Index. We also run a liquidity screen. Then we remove all stocks with the Refinitiv ESG rating below A-. So we're only keeping the highest rated ESG stocks. Then all remaining stocks are ranked based on a combination of their ESG rating and their human factor score. All stocks are then removed except the 50 with the best scores. So what we provide is a portfolio comprised of 50 highly rated stocks with low human factor scores, and the portfolio is weighted by market cap with a 15% cap on maximum position size at time of rebalance. And this portfolio is also rebalanced quarterly. So Julian, would you like to tell everybody how they can get access to the H factor system?
Yeah, so we've reached the point of the end of the presentation, and we're now ready for questions and answers if there are any. But while we're taking the Q&A, I've put a slide up here that basically will provide you with contact information. And this contact information can be used to gain access to our H factor system, or if you want to speak to any of our portfolio specialists about our ETFs. To gain access and to get a password to the H-Factor system, it does require that you speak with one of our portfolio specialists. I covered just a very small amount of the functionality of the system, so they will walk you through and show you how to best use that in your practice. To schedule a call with a portfolio specialist, you can simply go to avoidthelosers.com and fill out a form, or you can call us directly at the number listed over here. And with that, I think, Mark, let's open it up to questions into Q&A.
Yeah, let me encourage everybody to, if you have a question you'd like to ask, enter it into the Q&A portal. I'm going to jump in there and take a look, but maybe just to get started, Andy or Julian, why don't we start with a question that we often get. What do you expect to be the primary driver of our outperformance? Is it stock selections, sector selection, or a combination of both?
Andy, you can.
Well, it's always stock selection, and the reason is because, you know, the H factor is applicable to all, really to any stock, and we're not making a focused effort. We're not making any deliberate effort, I should say, to allocate to one sector, to another, or to one size or style. Instead, what we're trying to do is we're just trying to find the stocks that have the lowest probability of failing to deliver. And, you know, you might have stocks that have both high and low human factor scores in the same sector. So it would be wrong for us to focus on that. We're very much focused on security selection.
Thank you. Let's see, we have a question here. How does your model account for the law of large numbers, such as growing 100%? Let's see, from 1 to 2 is arguably easier than growing that same 100% from 2 to 4.
That's a good question.
Yeah.
The beauty of using growth is, you know, the law. I would agree that the law of large numbers, if you held everything else equal, would impede the ability to continue to grow, and that you would see sort of diminishing or decelerating growth over time. But really, companies that have delivered high growth often have easier access to capital and can continue to grow, and even accelerate their growth through time, I believe. Now, what I started to say was, you know, the beauty of using growth as opposed to simply revenue or simply earnings or simply cash flow is that we can we can anticipate the way that a company is going to perform, regardless of whether that number is attractive in and of itself. So if we were to simply use revenue numbers or simply to use earnings numbers, we wouldn't have the same benefit of really gauging the direction of the company. But if we use growth numbers, we can. Do you have any thoughts on that question, Julian?
Nope, I think that is correct.
We have another question in the portal. It's kind of a lengthy one, so I'm gonna let me read it and try to get to the question. So the question is the logic of investing based on the probability that a company fails to deliver against expectations with its current price serving as a benchmark is refreshingly sound. But what does that do to the investment time frame desired by the client versus the duration required to achieve the expected return? If portfolio management practices are tilted towards what actuaries do, then wouldn't duration management become front and center in the investment process? How will clients react to this, and how do we manage regulatory concerns?
I don't understand that. Maybe
I think I can address that, Julian. Right. One of the things that we've looked at is how well does human factor not necessarily allow us to select stocks that perform well, but how well does it do what we claim that it does, which is measure the probability that a company will fail to deliver. And the way that we have done that is 1 quarter forward. So really, when we talk about the probability if the probability is 20%, that means that in time, stocks with a 20% probability will fail to deliver the next quarter 20% of the time. Now, we have shown this to be the case by grouping stocks into bins and measuring the likelihood, or actually the frequency, I should say, the frequency that the companies do fail to deliver. And what we found is that companies with a human factor score of between, say, 5 and 10% tend to fail to deliver the growth implied by their stock price at that next earnings or that next financial statement release 5 to 10% of the time. And companies that have a human factor score between, say, 45 and 50% over time will fail to deliver the growth implied by the stock price, 45 to 50% in the next period, when the next revenue growth numbers are released. So in that way, I think the answer to the question is likely that we're really only focused on one quarter forward, and for that reason, rebalances take place quarterly as well. As Julian mentioned, the human factor scores changed the most at that new the publication of the new financials, because we now have a new growth number that we need to work into the distribution.
What I was trying to understand is the question around regulation. I wasn't following that, the question.
I'm not sure.
Yeah, it's related to how will clients react to this, and how do we manage regulatory concerns, regulation, best interest. So I believe it's ensuring that that the changes in the portfolio, would be oriented towards the client's best interest. And I believe by using the H factors tool to eliminate and select stocks, I think that definitely aligns.
Well, I would simply argue, you think beta, volatility, value rotations, growth rotations are in the best interest of clients? No, it's completely, that is the human factor at work and at its best. We're asking a simple due diligence question, simple one. Can the company deliver the growth implied in the stock price? Yes or no? That is in the client's best interest. It's not whether we should now be rotating into value or growth or using beta or volatility as measures of risk. That is exactly what the human factor is. And that's what we've been sold for too long, and that's what we've been taught is right. And we're here to argue tonight it's not.
We have another question here. Have you tested this model from 2000 to 2010? Did it show efficacy in that time frame? And additionally, have you measured the H factor versus different lags of momentum?
Well, we've done the first part. Right, Andy? We've gone all the way back to 2001, and we have all the data going back to 2001. In terms of the momentum efficacy, Andy, any comment on that? Because I'm not aware of what we've done there.
Well, I think that's captured in the way that we perform. Momentum has worked well as a general rule. Momentum has worked well with a couple of exceptions for the last 20 years. Human factor has also worked well over the last 20 years. I think if you try to find analogies between the returns of those two factors, you will find them simply because both have done well. If you look at individual stocks that are classified as being momentum or being low human factor, that's where you're going to see the difference. So it just depends on if you're looking at if you're analyzing it on a returns basis or on a holdings basis.
We do have another question here. What is the turnover of the long short portfolio? Maybe for the benefit of the audience, just a quick overview of our long short portfolio.
So Andy, you want to do it?
Sure. So we have a long short portfolio that includes 20 stocks long and 20 stocks short, and that's rebalanced monthly. The turnover is, there's different ways to calculate turnover when it comes to short shorting stocks. But in general, the turnover is really is very reasonable considering the monthly rebalance and the number of holdings. Most of those holdings do change from month to month. I would say not most of them, a lot of them change from month to month. So the turnover will be high, but the alpha more than compensates for that.
Well, I'm not seeing any more questions, and we're approaching the top of the hour. So if anybody has any questions, we'd be happy to take them now. If not, we'd like to thank you for your time this evening. We hope you enjoyed this presentation.
Yeah, thank you very much, everybody.
It's been a pleasure.
Thank you.
Thank you guys. This was wonderful. So thank you so much.
Yeah, thank you very much for having us.
No problem. We look
Yeah,
forward
great.
to maybe having you guys in the future again.
And thanks a lot.
Yeah,
Thank you very
be
much.
happy
Thank
to.
you.
No problem. You guys have a great rest of your day. Thank
Thanks,
you.
Brody. Thanks for your help.
No problem.
Bye.
Thank you.